If you have excess cash, there are strategies you can employ that can help make your cash work harder for you than just sitting around in a bank account. Okay, let's take a look at money market funds next. Money market funds are mutual funds, and these mutual funds invest in low risk, highly liquid assets like short-term paper, treasuries, CDs, and commercial paper. These are called near cash investments and are considered low risk because one, they're backed by the US government, or two, they're FDIC insured, or three, so short term that the risk of corporate default is minimal. However, they do carry slightly more risk than a high yield savings account, since that account's all cash. So they do tend to earn slightly higher rate of interest when compared to that high yield account we just discussed. And similar to high yield accounts, a money market fund earns a higher rate of return when compared to traditional savings accounts, again, with the spread depending on the interest rate environment. Please note that money market funds, they're not held at a bank, so they're not FDIC insured. Rather, they're covered by the SIPC insurance. And SIPC insurance only covers insolvency of the broker, not market losses. Now, SIPC insurance is very similar to the FDIC. It insures investors up to a limit of $500,000 in cash and securities per account, and up to $250,000 in cash coverage. You're going to say, wait a minute, Deanna, you just said money market funds are FDIC insured, and then you said they're not. So the key thing here is that there might be holdings that are inside the money market fund, and those are FDIC insured. But the money market itself is insured by the SIPC. When might you look at money market funds? Again, these are for investors who have a short-term monetary goal. You might want to reduce your overall portfolio risk, but you don't want to take all the money out of the brokerage account itself, so you'll hold it in the money market fund. You want to earn a little higher interest than what you can get in a high yield account. Or perhaps you're a retiree and your money market fund holds your dividends and interest payments that you aren't having reinvested, so you have the money there available to you easily when you need it. Most mutual funds are either actively managed with a fund manager making independent decisions on what to buy and sell with the fund, or sometimes they're just tracked to track a market index. Money market funds, though, they're a little different. A money market fund's goal is to maintain a stable value of $1 per share, and the gain comes in the form of interest payments, usually made on a quarterly basis. And generally, you don't buy shares. You typically invest a set dollar amount, $5,000, $10,000, $50,000, etc. And unlike a high yield savings account where you get the money immediately, a money market fund must raise cash by selling some of the investment. So there might be a few days lag between requesting the cash and receiving it in your bank. The underlying thought behind all of these strategies is that they are short to medium term in nature. We strongly recommend that you work closely with your advisor and craft a strategy that is flexible and resilient, but can also meet the limit.